Market breaks the 50-day moving average. What does that mean for you and your money? That's coming up on 3 minutes on Markets and Money. Yesterday, a stronger than expected Jolt survey sent the stock market falling very rapidly. We had said yesterday morning futures were pointing higher. We were looking for a bit of a bounce off the 50-day moving average yesterday. That Jolt report was so strong, though, that brought concern back that the Fed may be even more aggressive in terms of hiking rates as the employment situation still remains very strong. Now, underneath the surface, employment really not that strong, particularly when you take a look at labor force participation rates. But the Federal Reserve right now focused on fighting inflation. That's what really sparked that sell-off last Friday following the Jackson Hole Summit speech from Jerome Powell. That followed through yesterday with that sell-off on that stronger than expected employment data. That dropped us below the 50-day moving average. Now, we've been kind of warning this is kind of that kind of line in the sand here. That 50-day moving average is really part of that uptrend line that we've been building from the July lows. So this break of the 50-day potentially sets up for the market to retest these lows back from July. And so that's where we're kind of talking about where this market could drop from basically about 39.80 now back towards that 3,600 level. Again, that's certainly a concern here short term, particularly with sell signals, as we said yesterday, still in place. But markets are very oversold here, just like we said yesterday. Big oversold condition on markets. So that certainly gives us the ability to have a little bit of a reflexive rally. So be careful with the break of the 50-day here. Don't write it off just yet and say, oh my gosh, we broke it, we have to sell everything. Give this a day or so to kind of work its way out. If the markets can rally back above the 50-day by Friday, right, we close the week above the 50-day moving average, then this break won't be confirmed. However, a break below the 50-day, that we get a little bit of a rally today, fail at the 50-day, turn back down again, that's going to confirm this break at the 50-day and will suggest that we're going to go lower. And again, that will bring us in to start talking about maybe raising some more capital, raising some cash, reducing risk. Whatever rally we do get from here, if we do get one, and again, I think because we're so oversold here, a rally would not be surprising. But use rallies back towards the 20-day moving average. Any rally like that, continue to use that to raise capital and reduce risk in portfolios as we move into the latter part of this year. With the Fed being aggressive on hiking rates, $95 billion in QT starting this week. That's going to start to apply more pressure to asset prices as well, limiting upside, at least in the near term. Use rallies, again, to reduce that risk, rebalance portfolios. As we get into next year, that's where the real risk of a recession sets in as well. That's going to weigh on stock prices, also earnings and valuations. That's 3 minutes on Markets and Money. See you back here tomorrow.